Right. Thanks, Steve. I'm glad to see a few people back before lunch. Always not sure if it's better before lunch or after lunch, but I think both are not the best options to have panels. But we'll try to make it on time so that you are not leaving too hungry. Differentiated the importance of variety. Before we go there, probably let me introduce my fellow panel members. Brittany Baker, Director of Technical Sales at CyberCube. But you're doing more than sales because you're a qualified actuary. You've worked in a consultancy and audit for PwC before joining CyberCube. So I think you will provide a pretty good perspective on a risk that's, I think, on everybody's mind. So thanks, Brittany, for joining. We have Rob. Thanks for joining. You have a banking background. You've worked in the banking industry with Wells Fargo for more than 20 years, I think. But you have joined an interesting company which has been in the headlines called Vestu. You're a portfolio manager there, and you're building up the offering, I think, for Vestu. So it'll be very interesting to see how technology and investment skill may come together. And finally, we got James Lee from Aspen Capital Markets. You've joined them 7 years ago, 2015. I think Aspen's gone through a few things since. It will be interesting. But before that, you worked for Deutsche Bank, also obviously in the insurance industry. So I think it's a good variety of panel. You got modeling views, investor views, and let's say risk issuer views. Before I hand over, the idea we had running this panel was along 4 lines. The first one would be, what's our vision of a differentiated ILS offering? The second one would be, why do we think beyond Non-Cad ILS can be something interesting for investors? And then we thought we'd talk about success criteria that we would need to put in place to make it attractive. Then finally, what were roadblocks so far and what would be roadblocks to be removed if we want to issue more differentiated ILS offerings. Now, before I hand over to my fellow panel members, not sure if it's controversial, but if I look at the ILS space, and probably some of you know, I come from the other side. I've been a reinsurer for a long time. Now I'm representing investors. And I have to say, it's opened my eyes quite a bit over the last 2 or 3 years. But the availability of non-CAD risk is already there. Think about, we have a huge mortgage risk transfer space that's grown over the last years very, very significantly. So it's an offering that's out there. We have a live ILS space where we transfer mortality, morbidity risk already today, also to some extent longevity risk. We have seen recently new vehicles that are specialty casualty focused. We have seen runoff opportunities for investors. And also we've seen large investors, large institutional investors who have taken a different route into insurance investing by either taking equity, taking funds at Lloyd's, or other means. And another example there is the London Bridge initiative that's been up to make FAL investing, fund at Lloyd's investing, more attractive. So I would argue we already start seeing a quite differentiated offering. However, happy to hear the views of my fellow panel members. And Brittany, do you want to start first? Ladies first, obviously.
Yeah, sure. I think it's of no surprise to anyone who listened to my background. I would say really branching out into cyber as a peril. And I think a lot of folks who haven't spent a lot of time in cyber see it as one big amorphous peril. But there really are sub-perils that you can get into and segment them and look at them individually. I think there are also ways of looking at individual technologies in the digital supply chain. And so there really is a lot of room for innovation here, and not just thinking about that one big umbrella of cyber risk and having to understand everything that goes into it at one time. You can make these transactions or structures quite complex if you wanted to, but you can also simplify them and kind of start with one small niche piece and grow over time as investors get more comfortable with that peril, and as we see more historical events start to play out that people can compare to.
Right. We'll come back to that because I think the origins of ILS, when you think back after Hurricane Andrew, were very similar at that time. It was very confined, a very specific need, and a product built to specifically restore capital. So it's already a good point to revisit. But before we go there, Rob, what's your vision of a differentiated ILS offering?
Yeah, sure. First of all, it's a pleasure to be here with you all today on behalf of Vestu. So I think the easy answer here would be to simply pitch Vestu's strategy of targeting high-frequency, low-severity lines of business. There does seem to be a current moving in our direction, as you've heard from some of the other panelists today. But honestly, I think the answer is a lot more complex around this. In terms of vision, I think, simply put, to provide a differentiated offering that expands the ILS investor base is going to be crucial. I think providing multiple entry points for investors to participate in these products is going to be vital. And then obviously expanding capacity to cedents in a variety of different lines is going to be of utter importance. And I think having a strong technology backdrop to all of this that speeds up business process, makes it more efficient, and provides what I would deem to be attractive, stable returns to investors is all part of the vision. So what forms does this come in, right? So I think there's a couple different ways that we could access this. You could have professionally managed portfolios, people that are looking at this risk on a daily basis, providing good diversification and very prudent growth in these new lines of business is one way to go at it. A second form could be through fixed income, structured note type vehicles, where you aggregate 15, 20, 30 different reinsurance transactions into a single deal. We could get the buy-in from the rating agencies on this over time. We've certainly seen it through some other structures that Stefan mentioned. I mean, Bellemeade obviously has buy-in from the rating agencies right now. And you get some validation from the agencies on this, and I think this is a very interesting avenue for fixed income investors. And the last would be through a marketplace type structure, and this would be a technology interface that provides for seamless and very quick exchange of risk and capital between investors and cedents. And this would be the ultimate, in my opinion. And all three of these things are strategies that we're working on at Vestu. So, how do we get there? Again, I think technology is going to be of the utmost importance. We spend a lot of time and money on technology, artificial intelligence, trying to not necessarily replace actuaries, but replace some of the processes in actuaries and cut out some of the middle layers in the process of these transactions to make them more efficient, seamless, and data transparency, which I've heard throughout the entire conference today. Data transparency, I think, is going to be huge as we expand this business class into new lines of business. Education for cedents and education for investors are all going to be crucial as part of that process, too.
Thanks, Rob. By the way, if you have questions, please jump in. And we've heard this morning already some of the questions around liquidity or illiquidity that's within the space. How do investors get finality on the investment? So these are things that come to my mind when I hear you talking, actually. So it'll be interesting to explore that. And as I said, really jump in if you want to. But before we go there, James,
sure.
You want to take it from a kind of risk-bearing balance sheet side and probably shed some light on that, actually.
So I have a relatively simple view, even though we're talking about products outside of our core area of discussion of CAP. We should use thoughtful engineering to develop better products that meet the needs of cedents and investors. And if I think about that as the thesis, we could look at new lines of business. That's an easy one. That's a greenfield opportunity, but kind of bringing it home. Within CAT, I think everyone can appreciate that the insurance regulatory landscape, the rating agency landscape, that continues to evolve. And I think we've seen so much change, obviously following the events of '05, following the financial crisis, and continuing monitoring of kind of what's considered capital adequate. So I think the products that we're talking about also need to evolve. So the products today are great, but they may not be great a few years from now as regulations and rating agencies kind of change their benchmarks. So if I bring it all back, I think it's just thoughtful engineering to create products that better meet the needs of, again, both investors and risk-bearing entities.
Right. One of the questions that popped up this morning, I think quite frequently, is ILS investing interesting for end investors? And we heard the question around the wealth management channel, but more broadly also the frustration a lot of investors have had with some of their investments. Now, before I asked a question to the panel why they think NatCat or beyond NatCat investing can be attractive. To me, I think there's a differentiation to be made. I think NatCat investing, even over the last 5 years, could have been or has been in some segments attractive because it has produced returns. And the cat bond market is a good example for that, actually, just to qualify things here. So a differentiated offering can be obviously beyond NatCat, but even within the NatCat space, a differentiated offering can be looked at. So, but let's have a question answered then. Why do we think, or why do you think, that beyond cat offering can be interesting for investors, and what would be attractive to them if they went for it, actually?
Sure, I'm happy to start. So
Go.
I would say all forms of P&C insurance risk should be attractive for the capital markets. The problem is the bid-ask is pretty wide in certain segments of the market, meaning capital markets folks who are collateralizing their investments may need to earn a certain level of return that might not just be available from the P&C market. And so maybe they will converge over time, but or maybe not. But therefore, those may not make sense today. But if I were to throw out an example as to an area that could be interesting, I would say casualty insurance and reinsurance is probably a line of business that would make sense for folks to take a look at. So if we're talking about a narrow lens of no credit risk, full non-correlation with the financial markets, significant underwriting margin, it's probably not the line of business for you. But if we think about how big the capital markets universe is, if you look at the U.S. corporate bond market, it's $10 trillion outstanding. So clearly, there's a lot of capital there. So the question is, how do we bridge that gap and bring that capital into other lines of insurance risk? And so when you think about casualty, it has a profile where it takes a long time for claims to develop. And once they develop, it takes a long time for those claims to pay out. So can you think about structures where you're able to use that kind of float or that premium held through structure to generate enhanced returns for an investor that may not be as interested in just the pure underwriting margin? And so I think folks will come up with deals where you are taking credit risk, you're benefiting from operating leverage, you have some underwriting margin, and the full package delivers an IRR that is interesting to folks who might be currently invested in high-yield fixed income type products. And as another benefit, and I'm sure I'd love to hear Rob's view, but when we speak to investors, particularly folks with kind of a credit mindset, they really have a hard time with kind of jump to default risk, 100% loss given default. So if you think about these other structures, even though there might be underwriting losses, because it takes time for it to play out, there's a scenario where these structures pull back to par over time. And so the severity or loss given default isn't 100%, in certain scenarios. So I think some of these ideas probably resonate with the other part of the market that currently does not invest in cat risk.
If I can ask you one or two questions on that, actually. So fixed income replacement, understood. Illiquidity is an issue, isn't it, actually?
100%, yeah.
How would you overcome that point?
So I think over time there will be solutions to come up with it, but we have to start somewhere. So I would say that these ideas probably are not for everybody, but the demand for long-dated, illiquid debt, private debt, is incredibly high right now. You think about all the life insurance balance sheets with significant assets that need to find a home, and I think we've all observed that they've been moving from liquid products to illiquid because in this low-rate environment, they're able to extract a liquidity premium complexity spread that I think they also want to take advantage of in other products. So the answer to your question is it's not for everybody. I think over time, there might be provisions around more investors participating, so there might be some transfer opportunities, more runoff players participating to take on seasoned portfolios. I think we're in the infancy stages, but I think to start, I think you need to find those investors that have the ability to hold investments for 5+ years. And again, it's not for everybody.
Yeah, I would 100% agree with that. Just to kind of build on that, I think the conversation with investors needs to happen day one on the reality of this. I'm not sure if ILS is a liquid investment necessarily anyway. So you're already entertaining the discussion going into this saying, look, you could be locked up for a couple of years on this product. There's going to be significant education around how collateral release vectors work in these new lines of business, these longer tail lines, how paid loss vectors work. I'll come back to my data transparency comments earlier on. The technology interface that we're building at Vestu will provide as timely information as possible to investors to see actual versus expected and paid loss trends in transactions. So this is something that I agree with James. The liquidity might not be there day one, but it's something that we have to start somewhere. We have to build upon this. And over time, I think as more people understand the product and how the collateral releases over time, they'll grow more comfortable with it. These are all factors within the sector. Liquidity is probably one of my top 3 items that I focus on a daily basis with Vestu, to be honest with you.
I think just to add, though, just the counterpoint is I bet there are a group of investors that don't want it to become truly liquid because they want to enjoy the complexity premium. So once you start making it homogeneous, transparent, and liquid, it would dilute that section of the attribution of return. So it's a marketplace, and who knows what will happen. But just to be clear, there are segments of the universe that aren't motivated to.
Yeah, insurance companies.
100%.
Yeah, right.
They want to get paid for liquidity.
And I would agree, actually. The life ILS space is structured similarly to what you describe. It's a closed-ended space, often with longer-term investments. So it does resemble what you say. However, before we go to success criteria, which you already started to bring up, beyond the question is still, why is it attractive to offer beyond Non-Cad? And obviously, the elephant in the room is cyber risk, isn't it, actually?
Yep.
So it's very attractive for us as an industry on the insurance side and reinsurance side. Hey, can we find more capital to cover that risk and share it with the investors community? How can we convince them, and why is it an attractive risk for them?
Yeah, I think so. In my space, we've definitely been hearing rumblings, a lot of coffee chats from that group over the past 5-6 years. And it's really shifted gears, I'd say, in the last 6 to 8 months, with that interest becoming much more real. We see a lot more traction. And I think it's a few things. One is the increased demand for cyber insurance has not let up. And it's really been causing that with the experience that the insurance industry has seen from ransomware claims and premium corrections. There is a massive capacity crunch right now. And so just looking at that field, it's pretty ripe. And the other piece I'd say is that the emergence of people like CyberCube, modeling services like CyberCube, where we do have a solid, robust, comprehensive framework to model this risk. I've had more than a handful of people kind of look me dead in the eye the past few days and say, you can't model cyber risk. We can. It is a developing area for sure, but we can model it. And once people actually sit down and start talking to us and we walk them through our way of thinking, I see eyes start to open and start to really comprehend that we can understand this risk and these exposures and do some pretty innovative things here.
So I may get it as an insurance professional. I'm an end investor. How do I convince that end investor who has probably experienced that Non-Cad models have been somehow predictive, but have had their limitations as well?
Yeah, I mean, looking for that diversification outside of Nat-Cat, this is a completely new asset class, and looking for the yield that may or may not have been there the past few years for cyber, being the first to the space and being early, those margins are going to be bigger. I think the insurance industry, or the kind of other side of any transaction, is looking for that capacity. I think it will be priced well, and there will be very favorable structures to be had.
Which means we come to the success criteria, and if I understand you well, price is one success criteria.
I'd say that. I'd also say for the entire market looking at this, it's having that first transaction be something that the market accepts and that is repeatable. I think if there's a one-off transaction that everyone goes, great, claps all around, but we have no interest in doing a similar transaction, I think that would be unsuccessful. Like that would not meet the success criteria. We're looking for something that is repeatable and that people look to and say, yes, I get it, I understand that, that's something we're interested in doing, even if they're tweaking it, but doing something similar.
Right. Maybe we will explore that question later on our panel, Steve. We know some of our colleagues on the broker world are out there trying to structure risk transfer mechanisms, whether at the end of the day it's going to be 144A bonds or whatever. We don't know yet. However, I think there is a huge move, but it's not been successful so far, actually. I hear you, price, structure, and to be repeated structures might be success criteria. Anything else that comes to your mind which can provide comfort? We have a situation with the Ukraine crisis where we read every day in the press, hackers from wherever are trying to go after communities, after energy supply, after water supply, and you have me. So isn't that something where investors will say, not sure if I want to go there?
Sure, I've absolutely heard that feedback with groups that were kind of standing on the edge, maybe ready to jump in, and then the Ukraine situation really got underway and they said, well, we can't do that. We're unable. We're just getting our heads around cyber risk in general, and this has made it just a farther out of reach for us. I think one of the ways to really understand that risk better is to step back. When I talk to my cybersecurity colleagues and I look back at our frameworks and how we're modeling it, there's a lot more stability there than I think people realize. One of the ways, not to get too technical here, that we think about cyber attacks is through what is called the kill chain. It's a militaristic technique that breaks down an attack into 8 sequential steps that need to happen, one after the other, for something to really have an impact. And as much as we've seen new threat actors, new types of attacks, trends in different frequencies change over the years, nothing has deviated from the kill chain that we have set up on top of cyber risk. And so if you understand that, and if you're looking at the data and the threat intelligence that's coming from the cybersecurity community, Ukraine didn't just start in February or January for the cybersecurity community. They've been talking about that for years. So it's been on their radar. It's been on our radar for much longer. And so just kind of jumping in there is what I think can get people comfortable understanding that risk, even if there are situations that start popping up in the media and elsewhere. It wasn't unforeseen, this increase in frequency and the types of attacks that are being perpetrated right now.
Right. I think we could spend the full hour on cyber risk, but obviously the topic is wider than just cyber. But thanks, Brittany, to explore that a bit further. But success criteria for non-CAD ILS offerings. I think, well, we touched upon the fixed income replacement nature, the illiquidity premium. What I think has not been explored to the full extent is finality. I think even though you can prepare an illiquid investment for a certain amount of time, I think investors would struggle with accepting investments without finality. How do you think about that?
Yeah, so I can't speak about all products, but if I were to set the stage about kind of the things that we're familiar with, you may be afraid about, let's just say, a 10-year final maturity structure. That might just be too long for you. Perhaps it could extend out to 12 years, or there's extension mechanisms to make it even longer. So you might say, wow, that's way too long. What am I going to do? Well, if you think about these structures, they're not bullet maturity securities. How these work typically is that you have premium coming in, you have investment income coming in, and reserves growing. Those typically peak at a certain point in time, and then they tend to decline over time. And so if you think about kind of the way the amortization structures are applied, the weighted average life of your instrument is probably close to kind of 4 to 6 years. So most fixed income folks think about duration and weighted average maturities. And so from that standpoint, I think folks can get comfortable. Now, you might not get comfortable with the fact that you have to hold an instrument for, call it 10 years. But again, that's something that we'd have to figure out over time. But in terms of just how horrible is the maturity of these things, typically it's not quite as bad as kind of what you may be thinking.
Rob?
Happy to extend on that. Finality is actually a very big deal. And if I was sitting in the investor seat, I'd be very interested and concerned on how do we close out this exposure, because insurance by nature can have pretty significant tail risk attached to it. And there certainly are markets where you can sell that tail risk off if you want to pay up for it. But for what we're trying to structure, we've achieved finality. Again, I'm not going to, like James, I'm not going to talk across all products here. We've structured commutations into some of our agreements to achieve finality. With quota share deals, we purchase stop loss on top of the quota share to cap the risk. We're seeing a pretty similar maturity, call it 4 to 6 years in our contracts. We're trying to stay within those bands to really control the risk, and trying to avoid the super long tail lines where really the tail risk is ultimately unknown and you can't really hedge the back end. So, certain professional lines, workers' comp, for example, they just may be too long tail for investors to get comfortable with, at least ones that we're talking to and how we're structuring our transactions. So base case, we're trying to cap the risk as best we can through commutations.
Right.
I think just to point out, though, on the commutation, it's not like a magic solution, because if you're trying to ask a third party to step in and take over those liabilities, they're further removed from the original transaction. So you can imagine that they would probably want to incorporate a healthy amount of buffer to manage through that. At the same time, if you're asking the issuer, the ceding, or whomever is sharing the risk with you to take it back, that kind of negates the purpose of them actually sharing it in the first place, which is I'd love to manage my premium and reserve risk to manage my capital at the rating agency. So it's, unfortunately, there really isn't a magic solution. But I think over time, if you have other investors involved in the same transaction, then you have a scenario where multiple parties are involved that actually understand the structure and be willing to take on somebody else's exposure.
Right. I find my panel very interesting because two of them have a banking background. And I think having a banking background is great when you look at ILS investing, because often you guys think from an investor's perspective more than from an insurer's perspective, actually. So when you look at the space that we've seen so far, we've had a number of roadblocks, right? And this morning we've heard already the problems we've created over the last 5 years, the unfortunate situation that we have in the Non-Cad space, 5 bad years in a row, and things like that. Now, when you guys look at the roadblocks with your, let's say, called more banking background, how do you see those roadblocks, and what would you think would enable us to overcome these roadblocks or even remove them completely?
I think there are a handful of roadblocks, and maybe I won't touch on all of them, but obviously we should talk about I guess education is kind of an issue, right? So it's taken a long time for folks to become comfortable with cat risk. And obviously, the whole industry was in dire need of capital in '05, but the quote-unquote tipping point in ILS did not happen until, call it 5 to 8 years later. So it has taken a fair bit of time for the industry to kind of come around and understand these structures. It'd be naive to think that if we bring other lines of business, new forms of risk, that you would have kind of a pretty short turnaround in understanding those exposures, even within cyber. I don't think it's realistic to say that it's a new line of business. We have some modeling frameworks. Therefore, the capital floodgate should open for this exposure. I think it would take time for that education process to take place, and plus, they probably want to see some experience as well. So I think that's kind of a key roadblock. So whenever you think about a new risk, a new peril that hasn't been shared with the ILS marketplace, I think you just have to budget some time to educate.
Yeah, I would agree with that. I'd say if this was easy, everybody in the room would have done it by now, right? So, but there's significant challenges, even as we've built out our business plan and looking at these risks. If you look at the years leading up to COVID, I'll state the obvious here. I mean, pricing conditions in the industry were pretty weak. Interest rates were very low. It was a pretty significant headwind on returns. If a disciplined commercial insurer during that time frame was getting high single-digit ROEs on their business, and keep in mind they have a leveraged investment portfolio that's assisting those returns that generally doesn't exist in the ILS world as much, then I would think a disciplined ILS non-cat fund manager should be getting returns that are probably half of that, right? And honestly, that's not super attractive relative to what you can get in the market. But today, if you look at conditions, those items have reversed. Rates are moving higher. Pricing has been pretty strong for the past couple of years. We'll see where it goes from here. So I think those conditions have set the stage for this to be, something that we can consider. And education, I think, is huge, and I think there's going to be a huge ramp up there, not just among investors, but among cedents as well. I think model validation is also going to be huge for investors. I mean, everybody in this room that's in catastrophe risk is familiar with the big models out there, signed off on it, and clearly understands it. But there's not, and we heard on a panel earlier, there's not really a standardized model for some of these risks that we're getting involved in, particularly on the quota share side, which can be very complicated. So I think proving out models to investors and letting them understand some of the vectors and some of the issues I mentioned earlier, how expected loss blends together, is going to be absolutely crucial.
I think just to jump in there, another key roadblock, as I think about it, is structure. So within CAT, I think it's become pretty common knowledge as to how these deals work. And if you had to sum it up, it's you have cash sitting in a trust account that's available to support claims payments. When you think about other lines of business, so if you step outside of CAT and property, you tend to have longer development patterns, longer claims payment patterns. But you still have the same structure, which is you have an investor that's putting cash in a box. Okay. You now have an insurer or a risk-bearing entity looking to recover against that cash in the box. Questions start to arise. Well, how much cash is sufficient? How much do you need in there? And how long do you have to keep that cash in place? The longer you keep it, obviously for the investor, the more you dilute their return. So I think you need to have kind of a good structuring framework where you have both investors and cedents understanding each other's issues and agreeing that, to be commercial, we both have to, we can't get belts and suspenders all around. We have to be cognizant that cash has to be released from the box. To your point, Stefan, all the liabilities need to be commuted at some point at a reasonable time frame. So I think some of those components are also pretty important, and not all cedents probably are ready to take that journey because they're so comfortable transacting with rated counterparties, and that's actually a very good kind of way to do business. Like, why do you even have to worry about these things when you have AA counterparty risk on some of your longer tail lines of business? So I think that's a roadblock too, is how do you convince folks to share their risk when you have a very robust reinsurance and retro market in these other lines of business?
Mm-hmm.
Pretty, any?
I mean, I would absolutely echo education. When I commented that we do have models, I did not mean to imply that people should just understand them very quickly. It's absolutely something that we do all the time, whether it's talking to the insurance industry or investors now looking and considering creating a cyber peril ILS structure. So I'd say education is a huge piece. I'd say for us in cyber specifically, and I'm sure this concept kind of bleeds over to other lines as well, is event definition. So we have very clear, structured event definitions, but so do our competitors, and so do reporting agencies, and different sides of structures have event definitions in their minds as well. And so it's really coming to a place where we can agree on them. And back to one of my comments earlier, it can be quite complex, but we need to try to find a simplified, strict event definition to start with. And then from there, we can move farther out if that's successful. So yeah, very similar themes, I'd say, for the cyberspace.
Right, we've collected 4 points: education, model validation, structure, and definitions or event definitions. If I look at what happened in the last 5 years, and then compare, and I think the previous panel discussed it to some extent as well, what happened in the cat bond space compared to what happened in the broader, call it collateralized re, or the reinsurance and retro-driven space. Clearly the point of structure on the one side, but it's about remoteness. But definitely the point around event definitions made a huge difference for the eventual outcome for an investor. The cat bond space was very well driven by its structural features and by wordings that were very clear, very specific, without doubt. And I think, at least from what we saw, the investor response there was very positive because they could rely on the instruments. Whereas the collateralized re side has had the issues we've heard, and we've seen a lot of risk coming in that was unexpected and not properly priced, and so on and so forth, actually. So for me, definitely, that's been a roadblock and will be certainly success criteria going forward. Now, Rob, probably to explore a little bit further, I get your point that you look for low severity, high frequency books of business. And obviously, you have those books. In the US, you have books on the auto side, but you have also casualty lines or smaller commercial property lines, which might be suitable for that. Still, that risk transfer has a longer tail, and we said commutation might be a solution. But commutation comes with a huge cost. Yeah. So how do you bridge those, call it, 2 sides?
Yep. Well, just in full disclosure, I like low frequency, low severity the best. Okay, so our pitch is a company, high frequency, low severity. I'm like, what's wrong with low frequency, low severity? Yeah, no, it's a very valid comment. So what I will tell you is that the deals that we do have in force, we have about $2 billion of contracts in force. We have been successful in structuring these commutations up front. Everybody involved in the contract knows exactly how the deal is going to play out. We've been pretty explicit with our underwriting and financial engineering team that that's going to be a requirement for this to be successful through some of the strategies that we're employing as well. But it is a risk. I mean, the basis risk and cost on the back end of these transactions is notable. We've certainly had lengthy discussions about that internally as a team. And it's one of the challenges is, hey, like I said before, if this was easy, everybody would have figured it out. These are the conversations that are going on. And personally, I think the way to go about growing this business is very slowly and deliberately by starting with a few business lines that you can prove you can do very, very well. and have good relationships with your cedents, and everybody's upfront and clear about how this is going to work, and methodically grow this over time to provide that finality. But in reality, we know how these things work in the market. If losses start to get sloppy, you're going to probably see some of that on the back end. And those are just going to be constant negotiations and things we're going to have to work through.
Right. So the question I'm going to ask you is not prepared. So I hope you don't get it wrong. But putting myself in the shoes of an end investor, right? So low severity, high frequency is typically what's capped on a balance sheet of an insurance company or a reinsurance company.
Yep.
That's what we love, right? It's not very capital intense. That's the great stuff you want to have on your balance sheet with a predictability of an outcome, right?
Yep.
So what you want to lay off is severity on capital intensive. So if you went down that route, how could you convince partners in the insurance industry to share that risk? Or would you go, say, the MGA model and work with those guys and say, we compete with the other side, the insurance industry?
Yeah, I think capacity.
Sorry to make it a bit controversial, but I thought.
No. Look, we've debated at length closed-door discussions internally about these same topics. These are all relevant items. I'm glad we're talking about it here today. I think these are important points. I was going to bring up capacity. Where does it come from? The insurance gap, everybody knows the gap is pretty massive on the catastrophe side, but how do you quantify it on the non-cat side, right? Balance sheet companies love this risk, or do they? It's really a question mark. Look at retention rates within the US P&C industry over the past 20 years, right? Are they going to go from the low 80s? Are they going to go down into the upper 70s? Could they move around a point every other year? It's hard to say, but I will say one thing has been steady throughout my career, and that is capital requirements on the industry have been one directional, right? They just go up, right? And you have emerging risks every year. You have what seem like more violent weather patterns. Climate change is constantly a discussion, and that goes into the cat risk. But you also have changes with investment portfolio construction. We should be talking in this room about, are we seeing the green shoots of global deglobalization, right? What does that mean on loss costs longer term? There's always seems like there's a need for reinsurance support beyond cat, right? And we would not be here and be having this discussion if we weren't seeing tremendous interest from people. And our funnel is in the billions right now. And so the interest is certainly there, and these are in non-cat lines. And it doesn't seem like the interest is slowing down. So,
right. If I could now not go after you, but there's one thing intriguing to me, and that's the capital requirements on cyber, right? Mm-hmm. When we look at capital models that we have in the industry, you have AM Best BCAR models, you have Solvency II models, you have SST models, and they do quantify capital in a sense that they base it on modeled outcomes, right? For cyber, I think what we have is a few RDS scenarios in Lloyd's. Can be used. Is it reliable? Who knows? How do you see capital requirements that then eventually define risk transfer needs? Because that's the point we want to get to, right? How do you see that capital modeling for cyber coming along?
So I'd say even recently, we have been talking to groups who have essentially said, our cyber book isn't that big. We're going to, handle our capital allocation to cyber based on we're just going to add up all of the limits that we are putting out there. That's really capital intensive. If you start looking out at the models and the models that we have and even others in our space, in the tail, if you're looking at the 1 in 250 return period, it is a fraction of the limits that they are putting out there. So really starting to understand what your true exposure is. Sure, you can be conservative and take that former situation that I said, but you are going to run out of capital and capacity very, very quickly. So you have no room to grow. So I think groups just need to be understanding what what are the scenarios that are driving the tail? And absolutely, you have the Lloyd's scenarios that are out there. We collaborated with Lloyd's to create those, so hopefully people see those positively now that I've said that. We have a set of 36 scenarios that we look at. Only a handful of them are really driving tail risk. And so what we do is we have our clients really start to zero in on those and get under the hood and understand what are the true loss drivers. And from there, they can make decisions on which ones they're using to manage their capital allocations for cyber. And so I think it is really just understanding what those true exposures are, how you understand the footprint of those events, and what are those events. Because like I said, there are a handful that are driving that true tail risk there.
Coming back to an earlier point, model validation. So how do you then eventually validate those models? And I got the point, you can build models, but still the beauty of the natural catastrophe space is that we have historical evidence. Whether this is still true, whether it's changing with climate change, we don't know. On the earthquake side, we have very few data points. I think everybody would agree. Still, there are a few data points that allow to validate a model. Do we have these on the cyber side?
On the CyberCat side, we don't. I mean, we have NotPetya, we have WannaCry that were true systemic events. We don't have that big, huge catalog. And frankly, even if we did, with the nature of that moving threat landscape, they'd probably be irrelevant a lot more quickly than you'd see in the NatCat space or other lines of business. What we do at CyberCube is we look at the events that have been near misses or maybe smaller in nature, not those true giant systemic events, and we see the overlap with our catalog. And we look and try to understand, did the event happen the way our model is saying it would have? Were they the threat actors that we thought? Did they go after the technologies that we expected? And what were the costs that were incurred? So first we were validating those scenario classes that we even have. And then you need to step through and say, well, what was the footprint of what happened? We look at it two ways. We look at known technology dependencies. We can see tech stacks of individual companies, and we use that to understand the footprint of a systemic event across a book of business. So did it hit the industries we expected? Did it go through the countries we expected? So looking at that footprint individually. And last is the severity piece. And frankly, we can learn a lot about the severity piece from non-systemic events. I can look at near-miss events or individually targeted events and use that to validate our costs. Data restoration costs, notification costs, investigation and response costs. I don't need a massive systemic event to see what those things cost. And so we kind of have to, at this point, just really break it down into its individual pieces to get that model validation view.
Right.
So Stefan, can I ask you a question?
Oh, definitely.
So where are you on investing in cyber now that you've heard from Brittany?
Well, it's a very, very valid question, actually. The conversations we have with investors are difficult, very honestly, exactly for the reasons we discussed here. We, as a manager, would love to bring cyber to the investor base. I do believe personally, but we as a manager do believe it as well. It would be a great addition because I do think you can master the modeling if it's done the right way, and I think Brittany gave us a good insight. But it's an uphill battle to find, be it institutional or end investors who are willing to commit.
Right. And then just as a one layer below, so CAT, is appealing because of the diversification story versus financial markets, and there's been plenty of studies around what happens to the financial markets following kind of a major disaster event. I think common knowledge or common suspicion is that if you have a major cyber attack on corporations, that would decimate their equity. How would your investors think about kind of taking on cyber insurance risk, mindful that it could be correlated with equity exposure as well?
obviously, that's the beauty of the asset class that we promote, that it's decorrelated, although I think Corey this morning mentioned it's not as decorrelated as we may think. I like that comment, by the way. But yes, but if you then look at mortgage ILS, for example, it's also correlated, you know?
Yep.
And it goes back to your point you made earlier on transparency in education. I think if investors understand that it's not decorrelated, however, it is correlated, but it's a risk they're taking and it's rewarded the right way, I don't think that is an issue. But I'm totally with you on the point of education, actually. We're heading towards lunch, and I think some of you might be very hungry. Before we do so, any questions from the audience, really? Jump in. Otherwise, I hand back to you, Steve.
Run to the end of the timer if you like.
Oh, can we?
We've got an hour and a half for lunch, so there's plenty of time for everyone to eat.
Right. Well, we've explored a lot. Maybe I'm hungry. No. Right. Let's see if we have questions, actually. Kathleen.
You started to talk about this, Stefan, but maybe if we could dig in a little bit more into what the investors are actually saying, right? So on cyber, on casualty, what is the pushback? What is the concerns? What are the things that they're worried about? Just so we could get a little bit more insight into that. You know, you said you'd like to see them invest in cyber, but you didn't really get to what is the end investor actually saying. Is it literally just they don't want to be the first ones and look like they've, you know, made a bad decision? Or what is it? What's the catalyst that's going to get this going? Sorry for my voice. It was fun last night, though.
Thanks, Kathleen. Well, I can boil it down to, but I'm very interested to hear what you're hearing, Rob, as well, actually. I can boil it down to one point that is called predictability of outcomes. I think ILS investors want to know, can they have a certain predictability of outcomes? And that's not, will I make 5% any given year? It's, do I stay within the boundaries of that investment mandate I've given to you? And are you sure you can fulfill that credibly with the right modeling? And that's probably really the question it boils down to we're facing. And then the associated question is, okay, do you need that diversification in a given portfolio with cyber where you perceivably still have a lot of uncertainty against the fact that ILS in a given institutional portfolio is already a diversifier? Why would you over-diversify that ILS portfolio, whereas ILS in itself diversifies already other asset classes within a private asset allocation, actually? So that's basically the discussions we're having with our investors. I don't know whether Michi is still around, Michi Knecht, but he may shed some more light on it, actually. But Rob, I think you may face similar questions, right?
Yeah, no, absolutely. I mean, and maybe those are all extremely valid points. I think some of our questions, just because of the structure of our company, is a little bit different. They tend to be centered around our technology because we've put so much into algorithms and artificial intelligence as one of our core underwriting sources in measuring volatility. There's a lot of necessary education to get investors comfortable with what we're doing. And we are trying to pioneer something new here. So there's significant effort and time spent with folks. And to be honest with you, I felt like my first couple of months at the company were spent on that as well. I don't come from an AI or algorithm building background. But it is quite impressive when you dig in and roll up your sleeves and get to understand what is going on behind the scenes here that can improve and speed up process and measure risk. And when you boil it down, it might not be as complicated as people think. This is still a relatively untested part of ILS, obviously. I mean, there are different products out there. But what are you benchmarking against if you're going to start to build up portfolios of risk around this? Well, there's not very much to benchmark against. And how do we validate, right? How do we back test your model and look at what you guys have built against, you know, investing in a traditional insurance company, right? And those returns by nature could be better over time, but you're taking blended cat risk when you're buying into a traditional insurer. I've spent my career investing in those companies, and you're also taking significant market risk at times investing in insurance companies. I mean, it might be very eye-opening, this comment to give to the audience here, but the S&P 500, the highest beta company in the S&P 500 at many times has been a life insurance company, right? So that tells you a lot about how you want to pick whether you want to take the risk at the source or you want to take it in the market with some of these companies. But I think those have been significant conversations for us.
Yeah, I don't need a mic. Don't worry about it.
We're recording.
Oh, okay. Sorry about that. James, one of the questions you mentioned about the correlation, or statements you made about the correlation between cyber and broader financial markets. What work has been done on that? I know it's largely been assumed, but has anybody actually dug under the hood to take a look at the extent of that correlation?
I think it was more kind of an observation based on looking at recent events based on single company equities. But I think there's just a sneaking suspicion that once we actually have kind of one of the systemic cyber events, that it would likely have an impact. Like we've all been talking about, we haven't seen it yet. But unless proven otherwise, I think that's kind of our assumption set. So we'd love to hear the other side of it too, like kind of from your standpoint.
Well, I am on the other side.
Yeah, so we'd love to hear the other side. Yeah.
You guys are on stage. Don't make this my
No, I'd say we have started looking at it. Absolutely. If you look at even the major individual events, a Target data breach or companies that have really seen significant losses, they do have a hit. It's very short-lived before it rebounds. Their stock price might go down a little bit. It might go down a lot, but it rebounds relatively quickly. And we've seen that happen over and over again. So that's one piece that gets us somewhat comfortable on some of those big losses we've seen. And for the systemic events that we have seen, again, we haven't seen the big one. We haven't seen the massive one yet.
Right, and the big one would be like AWS, for instance, right, if that were to go down. What would be the impact to the equity markets in that scenario?
So if you think about AWS going down, I think most people just go, oh my God, the entire world goes down. There are very few people capable of doing that across the entire globe. They're going to shut down one piece or the other piece, and even if it's a malicious attack, they'll be up relatively quickly, But what we've learned, and again, there's little to go on, is we do think that it will not be as fully correlated as people expect. We do expect that rebound to kind of come back relatively quickly.
Just a comment to add to the AWS is that AWS is not just like one single piece of cloud that can go down. It's distributed. It's distributed for sure. And there is some studies that has been done by Harvard HBR on the correlation of large-scale cyber events to financial markets. Now, it's not a lot of data in there. But there are some assumptions which are quite interesting, and definitely I do agree with the fact that the impact of like a cyber attack has been quite short-lived. There is some data on the NotPetya attack as well. There were a number of publicly traded companies that were hit in a large-scale attack, and if you look at the data, that has not been more than like a week or so. Everything came back to where they were. But my question is also to you, are there any pockets of investors who are more interested in cyber? Maybe we are not talking to the right people.
Well, not sure if we're not talking to the right people. I can only speak for Schroders here. Schroders has a pretty wide range of investors, which ranges really from, call it, wealth management over to the largest institutional investors in the world. And we're hitting investors with private equity, infrastructure investments, so on a broad scale as well, actually. And honestly, we do struggle with the topic of finding interest in not interested in cyber and understanding the risk and the risk transfer mechanisms, but the willingness to put money down when you have offerings in private equity that give you a 15 IRR for the last 5 years, right? It's as simple as that. That means even if the price is very high and attractive, people still think, is it worthwhile if I have alternatives? There was one more question. So we already have the yellow and red card.
All right, I'll try to make it quick. Solar flares, does that fit under cyber, or is that a natural catastrophe? You know, we haven't had one of note since '89. That was in Canada. It didn't affect most people in the room, but like it could happen at any moment and take out billions, trillions of dollars worth of technological infrastructure. If it's bad enough, is that covered in this space at all, and where does it fall?
So I'd say we don't currently have a scenario tied to solar flares. We do think about GPS systems going down, and that's something that could easily be impacted by solar flares. So I think you just really have to look down at the insurance policies and how they're stating it. I think some might cover something like that, and some might not. It's one of those things in the gray area right now, I'd say. But it's not a true, pure cyber trigger.
And I think if you're an CAD ILS investor, you should probably pay very close attention to kind of your policy wording. So your exposures to property loss, but you should really take a close look at kind of what your event definitions are and how those losses are calculated. So if you think about kind of traditional reinsurance policies, it's loss to property. So for instance, COVID had a significant impact on that sector of the market, even though you might not think of that as a typical natural catastrophe event. So you should pay very close attention to wordings, and I can't speak for all of the ILS securitizations and collateral reinsurance contracts out there, but I wouldn't be surprised if that falls in.
Why wouldn't that be excluded?
It's a fantastic question. I think it's a fantastic question to close off, because it shows, I'm almost certain, if we had the risk in the cat bond market, there was no doubt that it's not covered because it's not named. Whereas if you have it in the traditional insurance market, I'm 100% sure we would have litigation all over the place, including into the ILS market, and no one would know the outcome at the end of the day. So I think it's a fantastic question to close this panel. Sorry that we don't have the final answer to that, but wish you all a very good lunch, and thanks for your attention.
Solar flare exclusions in every contract.